Today, for the Series 6 exam, we're diving into the fundamentals of variable life insurance. This is a permanent life insurance policy, which means it is designed to last for your entire life as long as you pay the premiums. But what makes it variable? The key difference lies in how the policy's cash value is handled. Unlike traditional whole life insurance, where the insurance company guarantees a slow and steady growth rate, variable life insurance allows the policyholder to invest the cash value portion of their premium into a selection of investment options, held in what's called a separate account. Think of this separate account as a menu of mutual funds, offering different levels of risk and potential return, such as stock funds, bond funds, and money market funds. The policyholder gets to choose how their money is allocated, which means they are the ones taking on the investment risk. So let's break down the two main components of the policy and how they are tested. First is the cash value. Because the cash value is invested in the market, its performance is not guaranteed. If the chosen subaccounts perform well, the cash value can grow significantly, potentially much faster than a traditional whole life policy. However, if the investments perform poorly, the cash value can decrease and could even fall to zero. A classic exam question will test your understanding of this risk. For example, a question might present a scenario where a policyholder's chosen stock fund in their separate account drops by 20% and ask about the effect on the policy's cash value. The answer is that the cash value would decrease accordingly, as there is no floor or guarantee on the cash value. You bear all the investment risk. The second component is the death benefit. This is where a critical distinction lies, and it's a frequent source of confusion and test questions. While the cash value can go up and down, variable life policies have a guaranteed minimum death benefit. This minimum is the initial face amount stated in the policy. So if you buy a $250,000 variable life policy, your beneficiaries will receive at least that amount, regardless of how poorly the separate account performs. However, if your investments do well, the death benefit can actually increase above this guaranteed minimum. The insurance company typically recalculates the death benefit on an annual basis. A common trap on the exam is a question that suggests the death benefit can fall below the face amount due to market losses. That is incorrect. The death benefit has a floor, but the cash value does not. To help remember this, use this simple phrase: with variable life, your cash is on a variable ride, but your death benefit has a safety guide. This highlights that the cash value is variable and not guaranteed, fluctuating with the market's performance. But the death benefit is protected by a guaranteed minimum, the safety guide that ensures it never falls below the policy's original face amount. Understanding this dual nature, the variable cash value and the guaranteed minimum death benefit, is absolutely essential for passing your Series 6 exam.